an hour. We've got an hour for a conversation about the most riveting area of the law, being a fiduciary. You've got three lawyers here on the podium, and you'll hear extensively from two of them. That's Martin Wilder and Sarah Barker. You'll also hear from me, Kate Aughty, just as we launch into this conversation. We really want it to be a conversation. We would like all of you to feel like when you leave here, if you had questions about the role of a fiduciary in relation to risk management and corporate governance, that you've had them answered and that you go out with an action plan if that's what you sought when you came in. So please take us at our word when we say we would like to have a conversation. Each of the panellists will only talk for 10 minutes, so we've got 50 minutes and a lot of time to fill in, which means that it's down to you. Thanks very much. In coming here today, I asked Sue whether there was any need to make an acknowledgement of Aboriginal people at this session, and I don't think there is because it was done this morning, so I'll move on past that. Ordinarily I would. I'm chairing this as the chair of an organisation or an advisory board at the Melbourne University, which is called the Melbourne Sustainable Society Institute. It's an institute that's had some legs for some time. It was set up by Ruth Fincher, and it's continued under the aegis of the Dean of Design, Tom Cavan, and it has, in effect, interdisciplinary recognition at the university at Melbourne. It's called the Melbourne Sustainable Society Institute, and of course we're talking about what makes a society sustainable in everything that we do in that particular institute. But it's no surprise to anybody here, and there probably are some university people here, that universities themselves have found themselves swamped or overwhelmed by what I would describe as questions about the social licence of universities and what they do with their funds and how they invest or divest. So the Melbourne Sustainable Society Institute has been one of a number of institutes at the university engaged in a conversation about a sustainability charter. But I'm not here today to either talk about or justify the university's stance in relation to divestment or investment in relation to coal. The thing that's really very clear about universities is that in the last 3 years, and I've only been a Vice-Chancellor's Fellow since early 2014, but in the last 3 years in Australia, the movement to get universities to divest themselves of their carbon reserves in their investment portfolios has really taken off. And we've heard all through the morning about how the particular conversation about these issues and the action associated with it is really stellar. And there'll be some comments from Martin as to whether that's the case, and Sarah as to what that might mean from the point of view of fiduciaries. But if I was just to make a couple of observations out of this morning and put them in some focus with my comments here this afternoon, it's this. I was really intrigued by Stephen Hind's comments about what you do to make sure that you go around or remedy the governance issues in boards when you find that they are not capable of addressing the contemporary issues. And of course, most universities in their investment portfolios will say that they rely upon those as externally managed funds. And that's in fact often the explanation for why nothing can be done about managing these behemoths. And universities have tens of millions of dollars invested, as we all know. Externally managed funds has become one of the explanations for why nothing can be done to bring them into line with what we would all want to see happen, which is best practice in relation to carbon risk management. Hearing Stephen talk, of course, he said that you get yourself an outside CIO to overcome the problems of the inside CIO not understanding the changes that are upon us. And a light bulb moment for me was that observation, because he was talking about going outside organisational structures to remedy the problems of paralysis within. And of course, universities are saying that we have this overwhelming, overarching umbrella organisation about which we can do nothing. And in fact, there's probably some serious questions to be raised about that. Could I just make these very quick comments about universities? Everywhere, all over, people at universities are saying they want things done differently. And some of you will have gone and done the work that I have about this in recent days. The University of Hawaii, with an endowment of 66 million USA and 4 million of that in fossil fuel investments, has a task force of students, faculty, admin, and people coming together to talk about what needs to be done to reduce that exposure, and it is an exposure, but they're talking about the moral leadership that goes with doing something about those issues, and they're also talking about long-term economic arguments, which of course is some of what we'll hear from our other panellists today about the fiduciary arrangements or responsibility. The University of Glasgow, as many of you would know, with the Great Britain pound, 157.8 million, and 18 million of that in fossil fuel investments, also externally managed, as the explanation for why something can't be done about that. But they have said that they'll put an immediate freeze on new fossil fuel investments and that they'll work towards full divestment, and that's full divestment over 10 years. They're taking the view that it's socially responsible to do so, and they're taking the view that there are ecological and social impacts if they don't. The University of Warwick, with £14 million in endowment and £1 million in fossil fuel. It's not a lot of money, but it's enough to be a fraction of what they think they could be doing about the problems. Again, externally managed funds, talking about what they need to invest in as well as how they need to divest. The College of the Atlantic in the USA, with an endowment of 37 million American dollars and $1 million in fossil fuel investments, which is their assessment of what it is, what their exposure is. But it may well be that if we were talking about complete transparency in relation to this, that we might find that it was significantly more in each of these cases. I don't say I know that, but it's certainly a question that we might like to be asking. At that college, which is in fact an internally managed fund arrangement, they are talking about full divestment. They completed it within 24 hours after they made the commitment, and they did that in March 2013. They involved students in what they were doing, and they involved the board and the council. If we have a look at what else is happening here, of course, Melbourne University has a very active student cohort, which is protesting daily about the issue of what's happening with our funds. Swinburne University has taken the first steps to become fossil-free in December 2015, talking about a responsible investment charter and transparency. And as I said, transparency is a fundamental for the purposes of this conversation about the fiduciary relationship. If I just run through a list of some of the other universities who are talking about getting out of fossil fuel investments, it includes Oxford Brookes, the University of Surrey, Wolfson College, the University of Heriot-Watt, Cranfield, Birmingham, and the University of Arts in London. And there are others. I'm not suggesting that's an exclusive list. So I'm in a situation where, as a Vice-Chancellor's Fellow chairing a Melbourne Sustainable Society Institute, we are looking at how we're going to be dealing with the funds that the university has and how we're going to divest those funds when they are, as we know, coal exposed. I'm going to hand over to Sarah, who's going to take you through the theory of fiduciary relationships and obligations and duty, and then we'll come to Martin. Oh, you've got a mic.
I bought my own. Hope Qantas doesn't know it tilted me over the 7 kilos of carry-on luggage. But anyway, my name's Sarah Barker. I am a corporate lawyer. I am a corporate lawyer in the Asia Pacific's largest commercial law firm, Minter Ellison. We don't speak greenie. We don't speak ethics. We speak money, and we speak risk. And so the way that I wanted to approach this issue of fiduciary duty with you is in a way that will resonate with boards who care about nothing but money and risk. Because there are those boards who will get it, and there are those boards who won't. But for those who won't, there is nothing that focuses the mind like the spectre of personal liability. So we're going to talk about fiduciary duty in a way that frames action on climate change as an obligation rather than something that's just nice to do when you're feeling warm and fuzzy. So what I'm going to do is to talk to you about fiduciary duty as a first principles concept, because obviously if I'm talking about fiduciary duty to the board of an ASX corporation, to a large superannuation fund, the considerations that they will have when they're discharging their fiduciary duty might be different to those of the board of an endowment, the board of a charity, the board of an NGO, or the board of a government authority. But at a first principles level, fiduciary duties are universal in all those contexts. And there are fiduciary duties under different legal instruments, different forms of legislation and regulation that apply to directors on boards in each of those contexts. And in each case, they come back to the first principles I'm going to talk to you about. So, fiduciary duty. Lawyers love fiduciary as a word because not many people know what it means. And lawyers love feeling morally and intellectually superior to everyone else in the room. It comes from the Latin, which is another thing that lawyers love, the Latin fideus, which means fidelity and faith. Fido the dog is another derivation of this Latin fideus. And at its core, it basically means that you act for the best interests of another. So if you are a fiduciary, you are prioritising the best interests of another above your own interests and above those of any third party. So conceptually, it's pretty simple. There are two main elements that go into being a fiduciary. The first is trust and loyalty, because your principal, the person in whose interests you're undertaking to act, has to trust that you will prioritise their interests and be loyal to their interests. So that's the first half of the fiduciary equation. The second half is competence, because obviously it's no good for the principal if they can trust you, but they can only trust you to do a crap job because you're not that good at what you do. So the second part of the fiduciary equation is competence and doing your job well. Now, in application in Australia, all our fiduciary duties come back to some form of one or both of those parts of the fiduciary equation. So in terms of trust and loyalty, we've got things like the duty to act in good faith for a proper purpose in the best interests of the company in a corporate context. And on the competence side of the equation, we've got the duty to act with due care and diligence. So essentially to act as a reasonable person in the circumstances would. Now, on both those halves of the fiduciary equation, there have been developments in the law that mean that it is now not only consistent with your fiduciary duty to act on climate change, but that you will be breaching your fiduciary duty if you don't. So first of all, let's look at that first half, that best interests half, the trust and loyalty. Now, for the last 30 years, if you're as sad as me and you've been following the corporate social responsibility literature that's gone on for that period of time, you'll know that the primary debate there in relation to E.S.G issues is the extent to which any for-profit entity can actually have regard to E.S.G issues in their pursuit of profit. Because historically we've had this presumption that E.S.G issues are ethical, that they're non-financial, that they are inversely related to the maximisation of profit. And that's the mindset that a lot of fiduciaries remain in. That was then and this is now. There is now no doubt that climate change in particular is squarely a material financial issue. Now, that's not Minter saying it. Don't take financial advice from your lawyers. That's BlackRock saying it. That's MSCI saying it. That's HSBC saying it. That's Citi saying it. That's the Bank of England saying it. I could go on. But most tellingly for me, it's the World Economic Forum saying it. That bastion of socialism that is the World Economic Forum, where every year anyone with a social conscience seems to protest outside their door. This is a slide that Helga alluded to in her presentation very briefly. Every year they put out a list of the top 10 risks to the global economy that they perceive every year. And for the first time this year, the one at the top of the heap, failure of climate change mitigation and adaptation. This is the World Economic Forum saying this. And actually, if you look at that top 10 list there in terms of impact on the right-hand side, to me, really, there's only one, maybe weapons of mass destruction, that aren't directly connected to climate change. So it is now undeniable that climate change is a material financial issue. And therefore, in that first half of the fiduciary equation, it is undeniable that it is in the best financial interests of any organisation that this issue be taken into account. So what do you need to do? That brings us to the second part of the equation, which is the due care and diligence. So directors have to exercise due care and diligence when they're pursuing the best interests of their organisation. What does that mean? Well, it used to mean rocking up to a board meeting once a quarter, having a good old laugh, having a glass of wine and, running away until the next quarterly meeting. Not so much anymore. Directorship is a profession. The courts in recent years have really raised the bar in terms of what is required for a director to be held to the standard of a reasonable director acting in their circumstances. And when I'm talking to boards, I boil it down into 4 requirements that need to be satisfied in order to discharge your duty of due care and diligence. And I call them the 4 E's. Sarah's 4 E's of due care and diligence, because you've got to dumb it down when you're talking to boards, of course. So the first E is educate. Directors have an obligation to proactively and continuously educate themselves about current issues that are relevant to the discharge of their duties. That includes the operations of the organisation, what it does, its financial position, its regulatory environment, and the macroeconomic forces that impact on its operation. So, have to read the paper, have to stay up to date, and not just Andrew Bolt's, column in the telly or whatever. You've got to stay up to date. The second E is inquire, and if any of you have an English degree and say, Sarah, that should be an I for inquire, I don't give a shit, it ruins my system. Inquire. You have to be proactive in your inquiry. If you are not getting information about an issue that you know, because you've read the paper, to be material, and you're not getting information from your managers or your independent experts, it is incumbent on you as a director to ask and to inquire. And this is a continuous obligation. You have to revisit how contemporary issues may impact on decisions that you've made in the past. So there are our first 2 E's. We have to educate, we have to inquire, we have to examine the information that comes back to us. You can't just default to accepting an advisory position that's given to you. You can't just accept the recommendations that management's making in board papers. You have to read what comes back, you have to engage with it, and you have to make your own decision on that advice. And the last E is evaluate. You need to critically evaluate as a director what's put in front of you. You need to be a constructive skeptic, and you need to actively apply your independent judgment. So, the analogy I use for all of that is the maths exam, because I still have nightmares about Year 11 calculus. Even now when I'm stressed, it's X's and Y's, haven't studied for the maths exam. You remember back to Year 11 calculus, if you get the answer right in the exam, bonus, full marks. But if you get the answer wrong, you can still pass if you show your workings. And that is what the duty of due care and diligence is all about. It's not about jumping to the decision. Do we divest? Do we engage? Do we tilt? What do we do? It's not about that at all. I'm not going to tell you that you have to divest or that you have to engage or you have to do anything. What I have to tell you is that the law requires you to think about it, and to think about it in an educated way. I just wanted to leave you with a bit of a quiz. Who said this about the emissions business in the last couple of weeks? Nothing to do with the science, It's relevant what I believe, if markets believe it, if customers believe it, if investors believe it, if government is making a policy, then what I have is a significant risk in my portfolio that I have to mitigate. Anyone? 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 The CEO of the largest emitter in Australia understands, he's read the paper, he knows it's an issue. It was on the front page of The Australian, for goodness sake. You can't miss it. He's taken advice, he's thought about it, and knows that they have to take action. What do you do though? Well, I'm going to pass over to Martine to give you all the answers.
And we'll give you some of them. Martine.
So first of all, I think he's wrong up there to say it's not about the science, because the science is a very specific risk, which I'll come to in a moment. So I'm just going to talk a little bit about some of the practical experience applying some of what Sarah's said. I think at the moment we're in a very interesting sort of period between a lot of pressure to divest and yet not sufficient an adequate understanding of how to apply that and how to deal with that and how to reinvest. So at a practical level, the point that Stephen made this morning about governance and resistance is very, very important. The number of corporates that we see that are responding to shareholder pressure or others to actually put in place some sort of climate policy that actually respond to policies which these investors are putting out about what we expect on climate. It's being done at a very, very thin level. So quite often companies will do an assessment saying this is what we're doing on disclosure, here's what we're doing about tracking our emissions, we are looking at other investments, etc., etc. They might put forward some scenarios about what we think the future is going to be. They might test their portfolios against emissions. They might say they're going to do a few things differently. But on the whole, it's pretty thin and around the edges. And what we're actually seeing is a lot of the investors who are demanding that the companies in which they invest in actually take these things into account and demand things of the directors don't actually follow through. So, for example, CalPERS has gone after a number of companies saying, and Norges Bank as well, we will divest from your company if you don't do X, Y, Z. So the companies do X, Y, Z at a pretty high level, and yet something goes bad in the company, the commodity price goes down, sales are down, they suddenly walk away from those commitments, and the investors don't follow up. They don't actually see to what extent have those companies actually followed through on those policies, to what extent are they continuing to go on. So I think with this quite interesting time where there's a lot of lip service to a lot of these issues, but not pushing it much further. Secondly, as I said, on governance and resistance, when you think of some of the largest funds in Australia, including, I might argue, someone like the Future Fund, it has a chairman in the past who said that climate change is rubbish. That sort of directs through the organisation a belief that not everyone in the organisation has, but when you have organisations whose leaders make a particular point on climate, it does sort of set the agenda for others to follow. So governance and resistance, as Stephen was saying this morning, is very, very important because it does waste a lot of time. Information for boards, as Sarah said, being able to evaluate is also very, very critical. And some of the challenges that I see boards facing at the moment in terms of assessing these risks are firstly the rate of change. There's a great underappreciation of how fast things are changing and how rapidly technology is changing, particularly in the energy sector. Secondly, and I heard it this morning, many people are saying Paris changes everything. Paris actually doesn't change that much. Paris is an agreement that's been reached. It has quite an aggressive agenda. We're a long way behind on implementation. There's a long way to go. And when you look at what has to be done, what's going to be critical is the next 2 years and how much we actually implement a lot of what Paris does. Paris is a critical point in the process, but it doesn't actually change everything. And so it's wrong to sort of hang your hat that that's sort of the end all and everything will sort itself out. It's going to require a huge amount of investment and a huge amount of focus of the private sector and the public sector for funds to flow, particularly developing countries where emissions have to be reduced. At the moment, we're in a little bit of a state of paralysis of any of that funding flowing. The next point I'd say is the science. I think another thing that boards really need to understand and grapple with, and this is why I think Vessi is wrong, is the science. So in my experience, there are two schools of science. There's what I call conservative science, which is you have a suite of conservative scientists who sort of run the mantra as to where climate is and run you the bands that are sort of in the middle. Then there are the scientists who I say tell it as it is. And there are a range of those who are very well-respected scientists around the world who are saying to you the scenario is far worse than the middle ground, and that when you look at how fast things are moving, Paris is just not going to get us there. And so therefore, when you look at some of that science, what some of that science says about the impact on agriculture, water, the impact on investments, infrastructure, if you're an investor, those are the sorts of things that the insurance companies are factoring. So the insurance companies are using that real science, the investors are using the conservative science. And so that's another really interesting challenge that we see. Another issue also, which Stephen referred to this morning, is market changes. So the market is rapidly changing and people need to also be cognizant of that. But it's a very difficult issue to deal with. I just want to talk about coal for a second. So both COBAD this morning talked about investment in coal and where that was going. We also, Tim Buckley, also, very articulate on where coal is and the changes in that sector. Yet you can present a different argument that India is that going forward, the two major energy sources will be coal and renewables. That in China and India, high-grade coal will continue to increase in demand, and the number of power stations that are being built in India at the moment that are supercritical coal is a phenomenal acceleration. The number of power stations being built. So if you invest in a coal company that's servicing those markets, there's actually a very good return. So I've had a lot of discussions with investors who will run that argument by me and say, well, despite what Tim says, there's a very good market for that product going forward in those quite niche but broad areas. Now, the counter-argument to that is that if you look at what's happening in Germany, many of those power stations in India will either never be turned on or the pipeline of what's been approved will not actually go ahead. That's a pretty brave call when you're managing someone's money in a company that has a lot of those investments to say, well, we don't think there's a future for them, let's pull out. But those are the sorts of issues that a lot of boards are regularly struggling with. And it does come down, in some cases, a very clear market dynamic change, such as with Peabody. But in other cases, we're still, around the edges, what is a good investment and what is not a good investment is still something that has to be tested. And it's still something that we're working through. And just to say that you don't like investing in coal, in India, for example, or China, does not mean for your investors it's not actually a good investment. It's not a good investment from a climate perspective, but there are managers out there who will argue to you that it's a very good investment for the rate of return they have to make to their investors. So that's another one of the hurdles that you need to overcome in pushing the whole importance of climate and investment through. That's one of the arguments we often get that comes back to us. Having said that, however, I think it would still be a very brave person that wants to invest in fossil fuels going forward. And there are a lot of other dynamics that are going on. If you look at the legislation that Queensland currently has in Parliament around the liability of owners of coal, of power stations and the like, and coal mines and other investments that cause contamination, and the fact that that can extend arguably to investors as well as banks, as well as companies who take insolvency, etc., there's a real growing expectation that the polluter will pay for this risk. So climate is one aspect, but also understanding that with some of those investments, the law is rapidly changing around liability. So when you look at this, boards need to be aware of that as well. And that Queensland legislation that's currently in there's a big debate going on at the moment as to how far does that legislation reach. And so if you are on the board of directors and you're thinking of, you have an investment in a coal mine and climate's an issue and divestment's an issue, there's another key issue that's on the agenda as well. The other interesting issue that also comes up is if you do divest, what do you reinvest in? And this is an issue which I think we often hear some of the trustees say, well, look, I'm very happy to embrace the divestment, but at the moment I'm making a very good return for my investors, and so what do I reinvest in? And I think we're in a sort of period at the moment where it's really going in waves where you get an increasing amount of divestment that leads to a pool of capital. There are new things to invest in. As you invest in those, that sector continues to grow, leads to more divestment, which leads to more reinvestment. So I think we're going through a process where what you can reinvest in as a pool of assets is growing at the moment, but it's still, it still has to grow, and we still have to find those investments. So, as some of you know, and some of you in the room here, I'm on the board of the CEFC. One of the things that we have to do is look at investments in new technologies with new players in new markets, sometimes which are quite untested, and you're in areas where you are having people come to you who push the boundaries. So all of the director duties that Sarah talked about having to test investments, inquire, equally apply on the reinvestment side. And so simply saying I'm going to divest and reinvest in something that's a bit more sexy and fossil free doesn't necessarily remove you from those same obligations. And so I think we're in this interesting phase at the moment where people are desperately looking for new things to invest in, but the volume of investable assets does not currently match the volume of capital that exists. And many of the banks, JP Morgan, Morgan Stanley, Credit Suisse, have all announced billions of dollars they're allocating to clean investment. But those announcements are not new. Citibank announced 10 years ago it was going to do that, yet a lot of that investment hasn't happened because the asset base just isn't there. As I say, I think we're going through this transition phase where boards who are dealing with this issue there's a lot of issues on the table that you have to grapple with. But I think, to come back to sort of where Sarah started, I think the reality is that there is no doubt that there is a responsibility to take these things into account. There's no doubt that many trustees and investors aren't doing it. The law has significantly moved on, and in the UK it's a lot more advanced than the US, and Australia sort of sits in the middle. And I think as we go forward, you will see a lot more litigation emerge, as we're seeing in the US now. And it's interesting that in the US, the country that probably has the least favourable obligations with respect to directors' duties, it's the country that actually has the most litigation at the moment on this very issue. So I think it's only a matter of time before there's a test case in the UK or in Australia. People are working on it already, and it'll be interesting to see how that plays out. It's not good enough for you as a director to say, if you as a director object to an investment, you are still liable if you go ahead and make that investment. And if you have a director that's being, obstructionist or saying that we should invest in this, you should get that director to actually minute that decision, so that director has, it's well known that they've done that in terms of going forward. So I think the area is very fluid, it's very dynamic, it's very challenging, but the law is very much ahead of where a lot of investors are. So that's just my sort of personal experience.
I was going to go to Ben, actually. Can you hear me? I was going to just go straight to some of the audience, actually, and I was going to ask Ben, for instance, to make some observations about that, because we certainly heard this morning that in relation to the whole fiduciary question, it really doesn't get tested very often. You've come from GE. What's the general feeling in business about what that means for people, that there's been a lack of testing, and as Martine's now said to us, expect it to happen more often?
Thanks, Kate. Yeah, I think really at GE I was a fair way away from the board, but look, there were good things happening on the ground at the local level, and I think those messages were getting towards the top. You saw that the chairman was a regular visitor to Australia, and his story was always about, I'm not a greenie, I'm a Republican, I don't camp, but this is good business, and we're going to invest in clean tech research and development and create the products that are going to win in the new economy. Look, I think that got through pretty well. I'm not really an expert on the board discussions that went on around it.
Thanks very much. And Leora, you're here from Australian Corporate. Yes, do you want to make some comment?
Thanks, thank you,
Black.
Kate. The whole question about fiduciary duties is just, it's got this kind of deja vu feeling. We went through this all 10 years ago with various parliamentary inquiries, which came out very clearly and said that not only is it permissible, but it would actually be a lapse of fiduciary duties if investors were to ignore E.S.G factors, and we're just going over this Groundhog Day. And I really liked Sarah's explanation of the fiduciary duties. I'm going to quote you.
Good. And Ted, you've got your head down, but you certainly presented this morning on these issues from the point of view of coming from a government regulator from that sort of sector. What's your take on how the fiduciary obligation is going to play out in the next 5 to 10 years?
Well, Martin's was on the board, so everything he said, I guess I agree with.
What's the risk? What's the risk for people sitting here in this room about whether they do or don't do what Sarah's suggesting, the 4 E's and the responsible investment strategy and making sure things are minuted? I mean, not everybody's had your depth of experience in this room.
Look, I think there's a high risk, and I'm going to frame the answer a little differently because we're moving into uncharted waters, and it's going to be a while before people do map their way through that. And as you're mapping your way through that, you're going to careen along the ravine, and you're going to have some dust-ups along the way. So you need to be prepared for that. And whether it's just or unjust that you're being questioned on the decisions that you've made as an individual, that's going to be quite challenging to you. So you want to be very careful in terms of what you're doing and make sure that you're following best practice to the extent you know what best practice is. But that's the challenge. We don't know what best practice is.
Taking good advice and having a good board. Emma's here.
That's why Martin's there.
Emma's here, and I think you wanted to make a comment as well on this question of fiduciary.
I had a quick comment and a question, actually. The comment was just that I think in the workshop this afternoon, I understand that there's a video kicking that off, which kind of showcases the kinds of discussions that boards should be having around looking at carbon risk issues. So that's also a good practical example of exactly what Sarah was talking about. But my question was actually about whether or not you could both talk to some of the legal cases that we've seen in the US recently around misleading claims, and in particular misrepresenting internal consideration of the impact of climate change on investments, and just talk about that a little bit as well, because I think that's a really interesting development.
Did you have a question? Oh, I could go on.
I think it's actually a really interesting segue to the question of transparency in reporting too.
Just want to add quickly to what Sarah said. So back when the CPRS was first being, the very first version of the CPRS was being introduced, Climate Action Network Australia, some of you may remember this, launched an action against Caltex. And 6 Australian companies, I can't recall who the 6 were, under what was then the Trade Practices Act, on the basis that these corporates, Woodside was another one, these companies had publicly told their shareholders, don't worry about the carbon price, it'll only have a 1 or 2% impact on profit, it's going to be immaterial. Those same companies had told in Senate hearings it would have up to an 80% impact on their profit margin. So and they've been lobbying Combe on that view as well. And they took that to the Trade Practices Commission as it was then, on the basis that they were engaging in false and misleading conduct in trade and commerce. And interestingly, they would have been found guilty had the Act have applied to submissions to government. And so it was actually found that when you submit a submission to government in a parliamentary inquiry, that was not in trade and commerce, and therefore there wasn't a conflict in the two spheres. So what that demonstrates to you is that, and that was I think 8 years ago now. It's an interesting case, and people have been looking to redo that under ACCC legislation. And there's been a lot of carbon claims, as you know, that ACCC has prosecuted people for. So I think the interesting point about that is that in every jurisdiction, there are different elements of the law that people will rely on to get an outcome. And in Holland, with the case in Holland, it was a particular tort of, I think it was negligence, which is in Dutch law. In Australia, that competition law will be something which groups will use to go after people in the future. So people need to be very careful what they say. So it's just an interesting, that failed for technicality reasons, but these companies really didn't think very carefully about how they were managing the issue.
Meg, what were you wanting to ask?
I was just going to take a slightly different tack in terms of thinking about the board responsibilities and fiduciary duties around the skill sets on boards, both of understand and where you go if you're a board looking for advice, particularly in, and I should say, I'm really speaking in respect of my experience in the new technology area after Clean Energy Finance Corporation. It takes quite a different skill set and a different outlook and a completely different idea of looking at where to invest in this new area, and also a very different skill set and a different information to understand what's going on with the old economy as well in your portfolio. And so whether you or anybody from the audience could talk about that difference in approaching board decision making and where to go for these sorts of sources of advice that are reliable, because inevitably in the new technology areas you're dealing with companies that don't have long-standing histories, whereas if you're got a portfolio of existing fossil investments, they're probably the ones that you've had for quite some time, and so it's easy to actually be backward looking at their profitability. The problem is looking forward at their profitability and the risks. And similarly, in the new technology areas, you've got no backward, you've only got forward. So I think you really need a whole lot of very different skill sets and information sources. And so that's one thing that I'm interested in anybody's views on.
And that's about whether you micromanage the board in a way that means that the old hands leave, or whether you bring in the expertise if you can't do that. So, from the point of view of being on boards, what do you say in response to this audience's desire to know how they'd manage that level of complexity?
Meg, it's a really, really good question. I just want to start. I went to a presentation by a group called Blenheim Partners, who do a lot of board recruitment, last week, and we got onto the topic of diversity. And they said diversity is looked at all wrong. It's not just a question of male and female. It's a question of the spectrum up and down on skill set. The example they gave is if you've got a company. So one of the key issues at the moment is moving to this sort of digital economy and the whole transition there. If you've got a company that's moving into the sort of digital information space, that's how everything they do goes out. You need somebody on the board who's got some expertise in that sector and is actually working that sector. If you have a board so you need a mix of, as you say, the very old skilled hand who are very skilled in governance, and people who are very current. There's no good having a board of directors of an ASX 500 company who are all white male, haven't practiced in their profession for 15 years and are just sort of professional directors. Doesn't get you into the space. And yet a lot of our companies have that. So diversity is about having youth, having seniority, having different perspectives. But if you have too much of that, then it can also lead to logjam. So it's a really fine balancing act. Now, in a private company or a public company, it's probably easy to get that balance. In a government organisation, if you have a government that has a particular political desire to put certain people on a board, then you may get a different outcome, and it may be harder to do that. But I think it's a balancing act, and so putting boards together is a real skill in itself. And then secondly, as you say, getting advice is also key. And as Meg and Ted know, when you have to get advice about whether or not the government's able under the law to wind you up, you go to the best barrister in town. Whether or not, but when you want advice on specific issues, you've got to really find who the really good experts are and who the people are, and that is not always that easy. And people may have different ideas about that. But the final comment I'll just make, because I know someone's trying to wind us up.
2 minutes we've got.
The other comment I'll make is that if you've got a really good board, the interesting thing is that often that board who knows the sector very well. So in the CFC case, for example, it's a relatively small sector. You've got a board, most people who know a lot of people in that sector. So when someone comes up to the board who has an investment that, that person might have a colourful background, there's probably going to be a board member who knows something about that person and whether or not it's good, which is a starting point to then go and do more investigation and explore it. But I think having a board that's really across what you do as a business is really important.
And that raises the question of networks, and sitting around here today, probably many of you have met new people who you didn't know existed. Networks are so important to understanding those sorts of levels of detail, no doubt about it. Yeah. Look, we are going to run out of time, but I did want to ask both Sarah and Martine to say, give us some idea of what would be the 3 skills that you'd really recommend everybody leaves here with, dealing with these questions about fiduciary obligation in the climate we're living in. 3? 3 each?
Can I just have one?
Yeah, go for it.
The maths exam. You got to do your working. You got to think about it. Nothing to do with the science. Think about what the market is telling you that the direction of travel is, and get your directors to think about, well, what does that mean in our context? Doesn't matter what the answer is.
Yeah, I'll do three. I'll say firstly, understand all the issues that Sarah outlined about what your obligations are. Secondly, make sure you get the information and really press for it. And if you're not getting it, insist that you get it. And thirdly, ask the question. So if you don't agree with something or something's put before you, contest it. Don't sit there quietly. Actually question the decision and question, what is being put before you. And even if you see, something you would be amazed how many times something comes before a board, you go and Google the issue and you find things that are abhorrent and you think, why didn't anyone pick this up? Or just look at Facebook.
Maybe that's not the best advice, just to look at Facebook, but it's not bad advice. We have run out of time. Can I just say that in starting this conversation here today, we did ask you to talk more than we've probably given you an opportunity to do, but you've got the rest of the afternoon and you should all be hopefully armed with everybody's cards that you've had a cup of tea with today, so that your networks have been exponentially expanded by being here. And I started talking about what's happening at universities because that's about the social licence to pollute and the social licence to engage in running businesses in the current climate in a way as if we weren't living in a time of extraordinary change. I think that's the message that I take from the university work I do every day. Change is upon us, and it's fast, and it's not going to abate. On that gloomy note, thank you.